I just watched a video from a YouTuber that I check in with every once in a while because I respect what he's done. He's a young man and he's made a lot of money in the stock market. And he was sharing with me that he had just done put a put on a stock that had run up and then came down, and he made a buttload of money in a week. And then he shared with me that he had made about 200% on SoFi over about the last 2 years. And I thought, this is all wonderful, and I'm happy for him, but wait a second. Why I'm here is to learn how to invest and what I can do in the future. And my chances of mimicking or creating what you created in the past is kind of slim and none. So what I just shared with you on the thumbnail, it is meaningless. Yeah, my portfolio is up 30% in year to date, and which is on pace then to do somewhere in the neighborhood of 60%. And yeah, these are my top 25 stocks, and they're up, 65.6% year to date. But that's meaningless. What happened in the past isn't going to happen in the future. So what is important is, what is the price of SoFi going to be based on its financials, its income statement, its balance sheet, its cash flow statement, its liquidity, its efficiency, its solvency, and then how much of the financial TAM does it own, and what is it going to take, and what are all those numbers, and then what is Wall Street projecting? That's what matters. Not what happened in the past, but what's going to happen in the future. And so that's why I built what I call my tell sheet. I built it for myself to tell me, based on the price of any given stock that I'm following, what the price is today, what's the price going to be on January the 1st or 2nd of 2028. That's what I'm interested in, not what I made in the past on SoFi or on Applied Digital. What's the price of Applied Digital going to be 2.5 years from now? That's what's important. So put all that aside, and let me take you to my tell sheet, Kerry's tell sheet, and show you how it works. And this is important because I'm closing the bus. Bus is best of us investors. I'm closing the bus on October the 1st. I think we'll have 1,000 people seated on the bus, and they'll all be paying $60 a month so that I can afford to upgrade the quality of work that I'm doing on their behalf so that I can help them change their financial lives. So let's go to the tell sheet and see if this makes sense to you. I believe stocks tell you what they're going to do, and I believe that based on past performance of stocks that have gone up 200%. They're showing growth in revenues. They're showing growth in earnings per share, which is a result in growth in gross and operating margins. What's important, which stocks are important, are not those that are in white here. They're the ones that are in yellow and green. A stock that is based on the analysis of its financial condition and Wall Street's projections in the future, that is going to grow by 171% over the next 3 years and has an 88% probability of it happening. Not so much one that's going to grow by 50% and has an 85% potential of happening. Then you have to put the one that's going to get the 170 up against the one who's going to get 205, but only has a 72% chance of probability. So that's what I do. I use AI, artificial intelligence, to analyze the stocks, to look at their balance sheet, at their income statement, at their cash flow statement, at their debt, and find out, are they sound? Do they have a good business plan? And is it likely that they can succeed in that business plan? And who's their competition? And can they outperform them? Does history tell they can? Or is there too much risk involved? Here's a stock that this is Moderna. If everything goes the way that the Moderna staff believes it's going to go, with the drugs they have in their pipeline and the future in front of them, they'll make you 264% between now and January the 1st of 2028. But that's a 50% probability. Why is that? because the government's involved. That's why the Food and Drug Administration. And then you've got the insurance companies. They can have a phenomenal drug. They can cure cancer, Parkinson's, heart disease, whatever. But if it costs $1 million and the insurance companies won't cover it, well, you've got kind of a limited market there. So that's why it gets a 50% rating. But the numbers tell you that if they achieve what they're setting out to achieve, and based on their financial condition and the way the market is set up now, Nutella will achieve a 340% return on its money. Why is that? Because they're going to cure cancer. That's why. They've got a drug in the pipeline that'll cure cancer. But it's a 50% probability that it'll happen because, again, they've got to deal with the other elements of government and insurance company. But drop right down here. For 10% more, you can go into Navitas. Well, 350% return and an 80% probability. Why? Because the government has nothing to do with it. And neither does the FDA or the insurance companies. Their future depends on NVIDIA. That's right. They make a different kind of wafer that reflects heat. And if they can get the facilities built that they have planned to build, they got an 80% probability that on January the 1st of 2028, the price will be 350% higher than what it is today. All of these greens and yellows and white, it's all based on what the stock price is today, this minute, every 10 minutes, that number, the price stops or changes, and then projecting out based on their financials and Wall Street's predictions, that's what the price is going to be. So you need to only come down this chart and say, how much do I want to make, and at what level of risk am I willing to take to make that? And, okay, here's CFLT, 250%. Not as good as Navitas, but still a good. So if you can spread your money amongst the green ones and some of the yellow ones, and you probably want some Google and Meta in there as well. What is Google? Google's projected a 90% probability that if you buy it today, you'll make 30, almost 40% on it between now and the end of, or the start of 2028. Okay, that's better than a kick in the head. That's better than losing money. So that's how I approach investing. I can share with you what I've done in the past, as I did, but that's not what really is important. What's important is, what do the numbers tell you? If you go down, I think there's 50 stocks here. If you go down and go through every one of their books, their financial their earnings report, their financial statements, their balance sheet, their cash flow statements, and examine their liquidity, their productivity, their efficiency. If everything happens that their management team says they are set out to achieve, that's the return you're going to get. What more do you need to know? What you need to know is what's going to happen between now and next quarter. And we go in and we reanalyze. We go all through the numbers again. We reanalyze and we change those numbers. And then when we want, we move the date out to 2029 and then to 2030. And that's how you manage a portfolio. That's how you say, okay, what do I want in my portfolio? Pick a number. What do I want on my portfolio based on what I got today? And then just go pick the stocks that have the highest probability to make that happen. Don't go based on the fact that SoFi over the last 2 years made 200%, or that NVIDIA over the last 3 years made 500%. Don't base your future on that. Base your future on the fact that based on what NVIDIA is saying they're going to do, based on the price they have today and what it's going to be, they're going to make 21%. That's what the books tell us. Now, they'll come out with their earnings again tomorrow, and I'll rerun it. Samantha will rerun it based on what the financials tell us, and we'll change that number. Come back, and you'll see what the number is. I'm Kerry. I'm a retired financial advisor. I learned how to invest the hard way. I depended on the pundits. I didn't get their annual reports and go through them. I didn't take the time to know what I own, to go through the financials and say, does this make any sense whatsoever? Should a stock have a PE ratio of 258 as opposed to another stock who has a PE ratio of 12? Why? What's the difference? And what is the probability of what they're projecting to happen is going to happen? It's really just math. Now, up until now, you had to spend a lot of time at it. But 3 months ago, ChatGPT gave me deep research. When they gave me deep research, they made me as good as Goldman Sachs' best analyst, because I know the questions to ask. I know where to go to get the data. And then I know how to analyze the data, interpret the data, and project what it all means. I want you to find your way onto our bus, Best of Us Investors. I'm only going to, right now, allow 1,000 people on the bus to have access to this, because I don't want to dilute it. I'll have to figure out whether I can find a way to not dilute it and still keep my tribe members in a position where they can outperform any indices and any other or any ETF. Kathy Woods has got a good path going with their ARKK thus far this year. It's the only one I've found that is in the same vicinity, but she goes on a different, she has other limitations. When this all starts to collapse, and I have a formula that tells me when I can get out. I can go total, Kathy can't do that. So look it over. If I can help you, I want to help you. That's why I'm here. Kerry, retired financial advisor. Take a good long look at this.